We're going to continue this conversation. Anastasia Amoroso is here, Chief Investment Strategist for Partners Group of Private Wealth Business. Good morning to you.
Good morning.
We'll hear from the Fed. We'll see what happens. But where do you think this train goes?
Well, I think it looks like we're headed for the September rate cut, but I do agree with the conversation here, which is there's sort of not a good reason to wait, and there's almost not a good reason to cut in September either, given what we have today.
So there's no good reason to do either.
Well, yes, unless we finally get through the tariff impact that has been anticipated, that has been sort of feared for by the Fed. If we get successfully through that, I think the Fed will cut. I would say, Andrew, the reason for the Fed to point to a cut is that 4.5% interest rates today, about 2% in real terms. That is above restrictive. So, does the economy need ongoing restriction? Probably not. And the labor market has weakened, but is not weakened enough to, I would say, warrant those urgent cuts. So here's what I would say, though, from kind of the investor chair, especially the private market participants, is obviously a rate cut would be very much welcome. But at the same time, we have already seen rates go down about 1%, and we have seen lower use of leverage across the economy and across private markets, for example. So as a result of that, financials for many companies look better already. But if we get a rate cut in September, we'll certainly take it.
But you're betting on one.
Look, the market is betting one.
You think the market is betting on one?
The market is betting one. There's about a 65% probability that the market is assigning to a September rate cut. And
that's not a huge bet.
Well, relative to very little for July. But here's what I hope to hear from Fed Chair Powell this week, which is what and when and why will they actually cut rates? What are some of the characteristics? And I suspect he'll say something like, we want to see the impact of the tariffs, and we actually want to see what the tariff rates are, because we don't know that today.
When do you think you'd see that impact? And I'm not sure you'd even see that impact by September.
No, but you're going to see a couple of inflation reports. And I think there are two other measures, Andrew, to your point, that are important, which is market implied inflation expectations, which have been largely range bound. And I suspect they can continue to ease from here. And the other point that Joe was also making is the consumer inflation expectations, because remember, in one of the surveys, they've ratcheted up to 6 or 7%, and they've pulling back since those levels. So if we go through a couple of more months of no materially higher realized inflation, I suspect those inflation expectations come down across the board, and that's what sort of would give the Fed the license to cut.
Okay, if that's the case, you would own everything. You'd be buying everything right now, no?
Right. So,
and I'm not sure, and a lot of people think this is an overvalued market right now.
All right. Look, if we look at it short term, certainly there's a level of exuberance. I would argue this exuberance has been justified by the constructive news flow, but we are 30% off the lows that we've seen in April. We got high valuations in public markets, and we've also got overbought conditions. So near term, I'm not sure this is the exact buying point, but as a longer term investor, you have to step back and say, what is the earnings growth doing? What are the margins doing? And what are the valuations? And here, Andrew, I can compare and contrast the public to private markets. And especially in private markets, for example, we're seeing meaningfully lower valuations. We are seeing meaningfully higher margins, and also the ability to sort of build those margins. And we're also seeing higher earnings growth as well. So if we get the tailwind of a rate cut, that's obviously phenomenal. And I will say one more thing is if we continue to have these constructive capital markets, we're likely to see an uptick in M&A activity continue, I should say, because we've seen quite a rebound already in June.